a cold number to start. In a single 24-hour period last year, the crypto market witnessed a trading volume that surpassed the annual gross domestic product of a small nation. Billions of dollars changed hands in the blink of an eye. This fact alone can be disorienting. For some, it is a sign of a speculative bubble, a house of cards waiting for a gust of wind. For others, it represents the birth of a new financial system, a digital revolution in progress. We stand at a crossroads where the path forward for this volatile and fascinating market is far from certain. This essay will explore the critical signals that will ultimately determine its fate. Crypto is a digital asset. It exists only on computers, secured by a technology called cryptography. Bitcoin aims to be a form of money. Ether acts as fuel for decentralized applications, or dApps. dApps are programs that run on a global network of computers rather than a single server. It never closes. It is a constantly shifting landscape of hope, fear, innovation. Its future direction will be shaped by a handful of powerful forces. This exploration is not about predicting prices. It is about understanding the underlying currents that will either lift the entire ecosystem to new heights or pull it back into the depths. We will look beyond the daily noise and the sensational headlines. The goal is to identify the fundamental signals that will make or break crypto in the years to come. These signals are not hidden in complex charts or arcane code. They are visible in the actions of developers, in the decisions of regulators, and in the choices of everyday people. We will examine three primary signals that every observer, whether a seasoned investor or a curious newcomer, should be watching closely. Developments in technology, the movement of large-scale institutional money, the ever-present hand of government regulation. The first and most fundamental signal is the technology itself. The entire crypto universe is built on code, and the evolution of that code is a primary driver of value and risk. New technological breakthroughs can unlock immense potential. Think of upgrades that make blockchain networks faster and cheaper to use. These are called scaling solutions. They are like adding more lanes to a congested highway, allowing more transactions to pass through smoothly. A network that can handle thousands of transactions per second, rather than just a dozen, becomes vastly more useful for things like payments, gaming, social media. This increased utility can directly translate into long-term value. However, technology is a double-edged sword. For every step forward in innovation, there is a corresponding risk of failure. A bug in the code of a smart contract can be catastrophic. A self-executing contract with the terms of the agreement directly written into lines of code. Hackers are constantly probing these systems for weaknesses. A major exploit on a prominent decentralized finance platform where people lend and borrow crypto can result in the loss of hundreds of millions of dollars. Such an event sends shockwaves through the market, eroding the most precious commodity of all, trust. The future health of crypto depends on its ability to innovate securely. Therefore, the signal to watch is not just the announcement of new features. It is the demonstrated resilience and security of these features over time. We must ask critical questions. Are these new, faster networks truly decentralized? Or are they sacrificing security for speed? Are the platforms holding user funds undergoing rigorous, independent security audits? The quiet, steady work of developers building robust and secure infrastructure is a far more powerful bullish signal than a flashy marketing campaign for a new coin. The long-term winners will be the projects that prioritize security and reliability above all else. The second critical signal is the movement of institutional money. For years, the crypto market was dominated by individual retail investors, early adopters. It was a wild frontier considered too risky and unregulated for traditional finance. That is now changing, slowly but surely. Large financial institutions are beginning to take crypto seriously. Investment banks, hedge funds, pension funds. They represent trillions in potential capital, and their entry could be a game changer. Big money can provide stability and legitimacy. When a major bank announces crypto custody services allowing wealthy clients to securely hold digital assets, it sends a powerful message. The creation of regulated investment products like a Bitcoin exchange-traded fund would make it easier for traditional investors to gain exposure without having to manage private keys or navigate crypto exchanges. Institutional capital could reduce wild price volatility, creating a more predictable, stable market. But institutional arrival introduces new dynamics and potential risks. These firms are driven by profit and are accountable to shareholders. They may use complex trading strategies which could increase short-term volatility even if their long-term presence adds stability. Their influence could lead to greater centralization of power, which clashes with crypto's decentralized ethos. If a few large funds control a big portion of an asset, they could gain outsized influence over development and governance. The key signal is not just if institutional money is coming in, but how it is coming in. Are they simply speculating on short-term price moves? Are they making long-term investments in the underlying technology? Are they participating in governance constructively? Are they demanding higher standards of security and transparency? The behavior of these financial giants will shape the market's structure. Their participation could be the steadying hand crypto needs or a new source of systemic risk. The third and perhaps most powerful signal is regulation. Governments and financial regulators around the world are no longer ignoring crypto. They are actively working to understand and control it. Their decisions will create the rules of the road for the entire industry. These rules will have the power to foster innovation, or they could stifle it completely. Clear, thoughtful regulation can be incredibly beneficial. It can provide consumer protection. It can prevent illicit activities like money laundering. It can give businesses the clarity they need to invest and build for the long term. For instance, if a major economy like the United States or the European Union establishes a clear legal framework for digital assets, it would remove a massive cloud of uncertainty. Companies would know exactly what is expected of them. Investors would have greater protection against fraud and scams. Regulatory clarity is often a prerequisite for deep institutional involvement. It builds a bridge between the old world of finance and the new. Beyond technology, money, and rules, there is a simpler, more human signal: real-world adoption. A crypto asset's long-term value ultimately comes from its utility. Is it being used by real people to solve real problems? A network can have the most elegant technology and the backing of major investors. But if no one is actually using it for anything other than speculation, its foundation is weak. This is why tracking adoption metrics is so crucial. It is the difference between a fleeting fad and a lasting technological shift. We need to look past the market capitalization and focus on the user count. Real adoption can take many forms. A freelance artist in Argentina receiving payment from a client in Japan instantly with minimal fees. Using a stablecoin, a crypto asset pegged to a traditional currency like the US dollar. Gamers owning and trading their in-game items as non-fungible tokens on a blockchain. Communities using decentralized governance tools to vote on how shared funds are spent. Each of these examples represents a use case beyond simply buying a coin and hoping its price goes up. While we look for positive signals, we must remain acutely aware of the risks that can break the market. These are the cracks in the foundation that could cause the entire structure to crumble. The most obvious and persistent risk is that of security failures. The history of crypto is littered with devastating hacks, exploits, and protocol failures that have led to billions of dollars in losses. A single, large-scale hack on a foundational piece of infrastructure, like a major bridge connecting two blockchains, could not only wipe out user funds but also shatter confidence across the entire ecosystem for months or even years. Another significant risk comes from the projects themselves. The space is rife with scams, fraudulent projects, and poorly managed teams. This is known as a rug pull. Other projects may simply fail due to technical incompetence or poor market fit. Every time this happens, it sours the experience for new users and reinforces the narrative that crypto is nothing more than a digital casino. Furthermore, concentration among whales can enable manipulation. One large sale can crash a price and hurt smaller investors. This fragility is a significant barrier to mainstream acceptance. The crypto market will shock you again. That is not a prediction of failure, but a statement of its inherent nature. It is a young, disruptive technology navigating a complex world, and its path will be anything but a straight line. The journey will be marked by breathtaking rallies and gut-wrenching corrections. Trying to predict these short-term movements is a fool's errand. A more prudent approach is to step back from the daily noise and watch the fundamental signals that will shape the long-term outcome. The steady maturation of the technology, the deliberate entry of institutional capital, the careful hand of government regulation. These forces will determine whether crypto evolves into a resilient and integral part of our digital future or collapses under the weight of its own risks. The pulse of real-world adoption will serve as the ultimate judge. By watching the right signals, act not on impulse, but on informed curiosity. That is the most reliable compass for the inevitable storms and bright horizons that lie ahead. I am Ray Montoya, and this is Economics.